Financial derivatives are financial contracts whose value is derived from the performance of an underlying asset, such as a stock, bond, currency, or commodity. The most common types of derivatives include options, futures, swaps, and forwards. Options give the holder the right, but not the obligation, to buy or sell an underlying asset at a certain price, known as the strike price, on or before a certain date, known as the expiration date. There are two types of options: call options, which give the holder the right to buy, and put options, which give the holder the right to sell. Futures are similar to options, but they are contracts that obligate the holder to buy or sell an underlying asset at a certain price on a certain date in the future. They are commonly used by farmers, manufacturers, and other producers to hedge against price fluctuations for the goods they produce. Forwards are similar to futures, but they are not traded on an exchange. They are customized contracts, and the terms of the contract are negotiated between the buyer and seller. Swaps are agreements between two parties to exchange one stream of cash flows for another, usually based on interest rates or currency exchange rates. For example, a company may enter into a swap to receive a fixed interest rate, while paying a variable interest rate based on a benchmark such as LIBOR. Derivatives can be used for a variety of purposes, such as hedging against potential losses, speculating on price movements, or to generate income. However, they can also be complex and risky if not used or understood properly. Thanks for watching Finance in 2 minutes. We hope you enjoyed the video and learned something new. If you want to keep learning about finance without having to read a whole textbook, why not subscribe to our channel? See you in the next video.